in section C, we have got the part one is variance analysis. Like we prepare the budget, we see the variance, that is material variances, labor variances, variable and fixed overhead variances, and of course we see the sales variances based on selling price and based on which one profit. Variance analysis also is part of performance appraisal, like whether the cost variance is favorable or adverse, unfavorable, like that we decide. And also sales variances, is it favorable or adverse, like that we decide. Okay, that is part one, that is variance analysis. The second one is, in order to decide performance of companies or divisions, a transfer price should be fixed. What is transfer pricing? Simple. I am department A, I belong to department A. I am the in charge for department A, dealing in, let us assume, I manufacture cloth. In the garment factory, I manufacture cloth. So my output is cloth. You are the in charge of division B, which is manufacturing ready-mades. You will use materials. One of the material that you use is the cloth, that you get it from me. Okay. As well as you can buy it from outsiders. Let us assume I manufacture only 100% cotton cloths. Then you may use other material like linen or terry cotton and all, you may buy it from outside. So department B, you buy materials from outside, as well as you can get the goods transferred from me. Whatever the material that is required, which are manufactured by me, you can transfer it from me. So what is the price at which I should transfer? That is department A should transfer to department B. That is called as intra-company transfer pricing. What is the price at which within the same organization, one department will transfer to other department? We are not different companies. You are department B, I am department A. Okay, we belong to what? The same organization. The transfer price can be between two companies. Okay, two companies means under the same group of management. For example, I run my business in India. You are there in US. I manufacture and supply the goods to you. What is the price at which the goods should be transferred? The goods should be transferred. Now, this affects two countries' taxation. Indian taxation, the selling price of the goods which I transfer is taxable in India. And of course, for the purchase in US, you have to pay the import duty. For the purchase in US, you have to pay what? Import duty. The method should be totally different, because when it's going to be intercompany, it affects the financials of two companies. It affects the taxation of two countries. And of course, international tax law says if there is a transfer between holding and subsidiary company, okay, it should be at arm's length. What do you mean by arm's length? It should be at a fair market price. For example, to avoid taxation, what I will do is, for example, let us assume in India, I have to pay a tax of 20%. I have to pay a tax of 20%. In US, you have to pay a tax of 50%. In US, you have to pay a tax of 50%. I am a holding company and you are a subsidiary company in US. What I will do? The strategy that I will adopt is since in India, it is taxed only at 20% rate. It is taxed only at 20% rate. I will charge a higher transfer price. Normal market price may be like 300 rupees. I may charge at 400, 500 rupees per unit or per kilo, like that. Because on the sales or on the income, I pay only lesser tax. On the other hand, you get the goods, then you sell to your customers, okay, where your profit will become less. Clear, the purchase price will be high from India and you will get it and you will sell to your customers, you will earn profit. Okay, the profit will be low because you are getting at a higher cost from me. Profit in US will be low, so you will be ending up in paying what? Lower taxes. So that is possible. On the other hand, if it is reverse, let's assume in US tax is 10%, in India tax is 50%. Now what I will do is I will fix a lower transfer price. I will fix a lower price so that I will be paying lower export duty or lower income tax, and you receive those goods at a lower price, sell them at a normal selling price. You will earn huge profit that will be taxed at a lower rate. So sometimes people use this tactics. Okay, so wherever there is a higher tax economy, when goods are flowing from higher tax to lower tax country, okay, they will fix a lower transfer price. They will fix a lower transfer price. Why it is so? Because since it is taxed high, I fix a lower transfer price. I'll be ending up in paying lower taxes while exporting. And in your country also, you will be paying lower tax on your income. Suppose if goods are flowing from lower tax economy to higher tax economy, then I will fix a higher transfer price. Higher transfer price. Like that, they will adopt tactus. We'll adopt which one? Tactus. But international tax law says the transfer should take place only at arm's length. What do you mean by arm's length? Fair market price should be the transfer price. Fair market price should be the transfer price. These manipulations are found or caught by the tax authorities, and they say that this transfer price is not okay. Okay, though you charge 200 rupees, they will take the fair market value for taxation kind of a thing. Clear? If the fair market value is high, they will take the fair market value. If the fair market value is low, they will take the fair market value for calculating taxes. So international transfer pricing, all these things you have to consider. From where goods are flowing to where. Clear? But what is suggested is, this is what is suggested. When goods are transferred from higher tax economy to a lower tax economy, higher tax country to a lower tax country, fix a lower transfer price. So that the tax that you pay in higher tax economy will be low, and the profit will be higher in lower tax economy. Anyhow, you'll be ending up in paying what? Lower tax kind of a thing. When goods are flowing from lower tax to higher tax economy, okay, fix a higher transfer price to avoid taxes. But these tactics are known, of course, to the income tax authorities. And of course, you can find in US section 482 of international, that is Internal Revenue Code, the transfer price between US company and the segment of the same company in a foreign country should be equal to the price that would be charged in what? Unrelated third party. That is called as which one? Arm and length transaction. For example, I manufacture a commodity, I sell it to an unrelated party, not a holding company, not a subsidiary company. Unrelated party at 300 rupees means I should export to you at the same 300 rupees. Okay, I should not charge a low or higher price to avoid taxes. So that's what it is called as which one? Arm's length. That is called as which one? Arm's length. Okay, so you may transfer the goods at different prices, but income tax authorities will catch you out by looking at what? Other selling prices, revenues, and other things. Okay, so that is about international transfer pricing. International transfer pricing. But when an IMA question is asked, when goods are transferred from higher tax economy to lower tax economy, choose the lower transfer price. When goods are flowing from lower tax economy to higher tax economy, then choose a higher transfer price. If there is no, if there is no legal issue, if there is a legal issue, everything should be as per the fair price. That is about intercompany transfers. Okay, so to a related party, if you transfer, it should be at arm's length as per federal tax laws as well as per Indian tax laws. Then the chapter section C deals more with how to make a transfer between two departments of the same organization. Department A and Department B. Let me go with my original example. I manufacture cloth. Using the cloth, you manufacture ready-mades. Okay. Now, what is the price Department A should charge to Department B? What is the price it should charge to B? Number one, it can be a normal market price. Normal market price. For example, cloth, I make it for, let us assume a dollar, let's assume 3 per meter. Then I should fix the 3 per meter as the transfer price. I sell to my external customers at $3 per meter. Or if you buy it from local market, you have to pay $3 per meter and I will transfer to you. This is one approach to transfer pricing. There are multiple approaches. We'll see various approaches. What is the advantage of transfer price, of this transfer price? Can you tell me what is the advantage of fixing a normal market price as transfer price? Number one, easy to fix. Clear? I sell to the external customers as well as to you at the normal selling price. Easy to fix. Number two, my profit margin will not get affected. To the external customers also I sell 3 per meter. To you also I will sell it at what? 3 per meter. My profit margin will not be overstated or understated. receiving department margin also will not be overstated or understated, because you get at the same price. You get it at the same price. So everything will be at fair. Will be at what? Fair. The disadvantage is department B, you may not be ready to accept this normal market price as transfer price, because you are not getting any advantage of this. If I buy from market also $3, internally transferred also $3, then why should I transfer internally? Very well, I can go for external market buying. So the receiving department may not accept which one? Normal market price as transfer price, because in the normal market, I've got other costs like sales promotion expenses are there, dealers commissions are there, agents commissions are there, the transportation charges are there, other marketing costs are there. But whereas for internal transfer, those costs are not there. Then you will argue telling that, no, I will not accept 3 per meter as which one? Transfer price, because there is no advantage for me. Like that you may feel. So that is the first approach to transfer pricing. Second approach is full cost transfer pricing. So what do you mean by full cost transfer pricing? Sir, I manufacture the cloth, variable cost, let's assume it is $2 per meter, plus fixed cost I incur $0.4 per meter. So the total cost incurred is $2.4 per meter. So you will tell, see, you are having excess capacity, transfer me at cost, transfer to me at what? Cost. And I will be also ready to transfer at cost, because I am not losing or gaining, and at the end we both belong to the same company. We belong to what? The same company. If I charge a profit, it is a cost for you. Or if I transfer at cost, if you sell it at your regular selling price, it's a profit for you. Overall profit of the company will not get affected. That is called as which one? Full cost transfer pricing. What do you mean by full cost? Include all variable cost of making, include all fixed cost of making, and transfer it. This is one approach to transfer pricing. That is called as which one? Full cost transfer pricing. And third approach is variable cost based transfer pricing. What is variable cost based? See, fixed costs are going to come whether I transfer or not. For example, I'm having a capacity of, let us assume, 20,000 meters. I can manufacture 20,000 meters of a cloth. Local market demand or external demand is there only for about 12,000 meters. 8,000 meters capacity I'm keeping idle. 8,000 meters capacity I'm keeping idle. Then if you're asking me those 8,000 units are, 7,000 units or 6,000 units, then you will argue telling that, see, for transfer, what is the cost you're incurring? Variable cost, $2 per meter. You transfer me at 2 per meter, because this fixed cost is going to come whether the transfer is made or not. Do you understand? My capacity is 20,000 meters. External customers, I am selling 12,000 meters. 8,000 meters additional capacity is available. 8,000 meters additional capacity is available. So if I make that 8,000 units or do not make that 8,000 units, okay, the fixed cost is going to be same. That is not going to change. Then you will ask me transfer at variable cost. So which I may be ready also, because overall department A and B belongs to the same company, but I may argue, since there is no advantage, why should I transfer? At 2? So that is called as which one? Variable cost based transfer pricing. Okay. There is something called as opportunity cost based. Sir, what do you mean by opportunity cost? Look at the same example. My capacity is 20,000 meters. I am selling to my external customers. Normal demand is 12,000 meters. I am having 8,000 meters spare capacity. My power looms are available to manufacture additional 8,000 meters. That is the idle capacity. Till 8,000 meters I can supply at variable cost, no trouble. But let us assume you are asking me to supply 9,500 meters. You are asking me to supply how many meters? 9,500 meters. If I have to supply 9,500 meters, idle capacity is available only to the extent of 8,000 meters. Idle capacity is available only to the extent of 8,000 meters. 1,500 meters, where will I go? I have to forego my local sales. I have to forego. Which means I will lose the external sales, those 1,500 units, then I will transfer to you. So here I lose. What I lose? I lose profit. I lose which one? Profit. That is called as opportunity cost. If 8,000 meters are to be transferred, no opportunity cost. If 9,500 meters are to be transferred, extra 1,500 meters, I should sacrifice the external sales and transfer it to you. The profit that I forego, the contribution that I forego from the external sales, we call it as which one? Opportunity cost. So that opportunity cost based transfers also can be done. So we'll work out a question based on all these models, then we'll move to the other models. We'll move to which one? Other models. Take up this question. Please take up this. What is the transfer price based on market price based approach? If division B needs, whatever may be the units, which may be 4,000 units or 5,000 units or 10,000 units. Okay, let us assume division B needs around 3,000 units. I will fix a transfer price of how much? $25 per unit. So to the external customer, whatever I transfer, the same price I will fix it to you. If the transfer is based on full cost, the transfer is based on full cost. The transfer is based on which one? Full cost. What to do? If the transfer is based on full cost, what to do? Simple. I will take raw material cost $10, labor cost $2, variable manufacturing overheads. I will take $10, fixed manufacturing overheads. Fixed manufacturing overheads. I'll absorb based on normal capacity. I assume that this is a normal capacity. So 1 lakh divided by 10. I'll absorb based on normal capacity $10 per unit. $32 will become the transfer price. Let me change the question. It's more than the thing. Just let's take it as 2. So what is the total? $24 will be the transfer price. So full cost means I will take both variable manufacturing cost as well as what? Fixed manufacturing cost. I will fix a transfer price of 24 per unit. And fixed overheads are to be absorbed based on what is normal capacity. Fixed overheads are absorbed based on which one? Normal capacity. If the transfer is based on variable cost, the transfer is based on only variable cost, then I will include only variable cost. I will include only variable cost. Hope you are copying along with me. So transfer price. What is the transfer price? $14. Transfer price $14 per unit. So we had seen the 3 approaches: normal market price, full cost, and variable cost based. We had seen. These are all simple approaches. These are all very, very simple approaches. Fourth one, opportunity cost based transfer price. This is most important for IMA questions also. Okay, if division B needs 4,500 units, if division B needs 3,000 units, there is no opportunity cost. See, look at what is the capacity available with me? 10,000 units. What is the external market demand to my customers? 6,000 units. So I have idle capacity or unused capacity. We have unused capacity of 4,000 units. So there is an unused capacity of 4,000 units, but the other division requires only 3,000 units. As per the base question, okay, they require only how many units? 3,000 units. Current demand 6,000. So I've got an idle capacity of 4,000 units. So in this case, there is no opportunity cost. There is no opportunity cost. What do you mean by opportunity cost? Nothing I lose for making the transfer. Okay, the transfer is within the capacity, so there is no opportunity cost. When there is no opportunity cost, variable cost can be the transfer price. Variable cost can be which one? The transfer price. Variable cost can be the transfer price. What is the variable cost? 14 per unit can be the transfer price. Do you understand? There is no opportunity cost. Nothing you forego, nothing you lose because of the transfer. So transfer price can be which one? Variable cost. Transfer price can be variable cost. Okay. If division B needs 4,500 units. If division B needs 4,500 units. Unused capacity, we have got only 4,000 units. But they need 4,500 units. So there is a shortage. There is a shortage, which means we have to forego external demand, external sales of 500 units. So what we forego, simple, contribution lost. Contribution lost is the opportunity cost. So what do you mean by contribution lost? If I sell 500 units in the external market, I forego that for transferring. Selling price is 25 minus variable cost is 14. Variable cost is 14 per unit. This contribution lost becomes opportunity cost. So $4,500 becomes which one? Opportunity cost. $4,500 becomes which one? Opportunity cost. So how to fix a transfer price? Transfer price will be variable cost. The base is variable cost. 14 into 4,500 units. Add opportunity cost. It is only logical. Opportunity cost is nothing but what you forego. 4,500 total transfer price. Total transfer price 63,000 plus 4,500, 67,500. If you want transfer price per unit, it is 67,500 divided by totally 4,500 units are transferred. So 15 rupees per unit will become the transfer price. This is called as opportunity cost based transfer price. So first case, the division B needs only 3,000 units. We have unused capacity of 4,000 units. No opportunity cost, nothing need to be foregone. So variable cost can be the transfer price. If division B needs 4,500 units, we have unused capacity of only 4,000 units. So we have to forego the external sales to the extent of 5,000 units. The contribution that you lose becomes which one? Opportunity cost. So what is opportunity cost? $4,500. That will be added to the transfer price. So total transfer price or revenue that we want is 67,500 per unit. What is the transfer price? 15. IMA question can be based on total transfer price or per unit transfer price. And here fixed costs are not considered. Fixed costs are not considered. Why? Whether you transfer or not, whether you make 6,000 units or 10,000 units or 4,000 units or don't make at all, fixed cost will come irrespective of the output. Irrespective of what? Output. You make 6,000, you make 6,000 plus 4,000 or sell to customer 5,500 and internally you transfer 4,400. Your fixed cost is going to be what? Same. So fixed cost is not considered here. That is a general fixed cost, not a specific fixed cost that is not considered. So opportunity cost based transfer pricing is possible. Practically also it is used and it is possible. Simple. We should ensure that the transferring department is not losing anything because of the transfer. Transferring department is not losing anything because of the transfer. That is called as which one? Opportunity cost based transfer pricing. If there is any doubt, please ask me. So market-based approach, you just take the selling price. Full cost approach, you include both fixed and variable cost for transfer price. Fixed costs are absorbed based on normal capacity. If the transfer is based on variable cost only, just include material, labor and variable overheads. That is overhead costs. You will get transfer price, that is 14 per unit. If it is opportunity cost, what is an opportunity cost? You lose something for transfer. If you don't lose anything, there is no opportunity cost. If you lose something, what is that? Contribution lost becomes which one? Opportunity cost. That will be added to transfer price. That will be added to transfer price. Any doubt in it? Please ask. Shall we proceed?
So opportunity cost in the $5,500.
5,000. Okay. Sorry, I made a calculation mistake. 11 rupees, correct.
Okay.
So it will become $15.22, correct. Shall we move to the next approach? The third approach, we call it as dual transfer pricing. See, in the same question, we can apply the dual transfer pricing concept. Dual transfer pricing means there will be two different transfer pricing. There will be what? Two different transfer pricing. For example, in this question, what is this ideal capacity available? 4,000 units. So I can say up to 4,000 units, the transfer price shall be variable cost. That is 14. Okay. If you want more than 4,000 units, then transfer price will be variable cost plus opportunity cost. Transfer price shall be variable cost plus opportunity cost. Opportunity cost will keep changing. How many units which I sacrifice, it will keep changing. So variable cost can, there is transfer price shall be variable cost plus which cost? Opportunity cost. If you want entire 10,000 units, I manufacture 10,000, you want entire 10,000 units to be transferred now, then I cannot sell below that 25. I will sell it at what? I will say transfer price shall be the normal selling price, because you would not allow me sell in the external market. So if you want transfer full 10,000 units means I may charge what? Full normal selling price as which one? Transfer price. This is called as what? Dual transfer pricing. Fixing different transfer price based on the units demanded. Units demanded. This I will give it as a chart to you, and depending upon how many units you want, then I will fix the selling price. Clear? If you want only 4,000 units, I can transfer to your variable cost. Because ideal capacity is there, let me do transfer at 14. We belong to the same company, same organization. So overall profit of the company will not change. If it is more than 4,000 units, I have to forego my external sales. I will consider opportunity cost. If it is 10,000 units entirely I should transfer, means then I will prefer which one? Normal selling price as which one? Transfer price. And Sixth approach is to the transfer prices. Maybe this can be a negotiated price. Clear? Transferring department will prefer higher transfer price. That is selling price. I will argue, I am selling the goods to external customers at normal selling price. I will transfer that price so that my performance is not understated like that or overstated like that. Receiving department will start negotiating with lowest transfer pricing, which may be variable cost. See, for the transfer, you are spending only variable cost, right? So we'll start negotiating, or you will start negotiating, asking for the lowest transfer price. Then I will argue telling that if I manufacture everything and sell it at variable cost, debited at cost, credited at cost. Otherwise, this is my cost. At the same cost I transfer to you means my department profit or loss at the end of the year, it will become zero. Cost transferred at cost, the profit or loss will become what? Zero. And the divisional performance, when they make it for the purpose of performance appraisal, it will show as if the transferring department has not performed at all. Zero profit. Return on investment is zero. Return on investment is zero. And receiving department, you are getting from me at my cost, and you will sell the product to your customers at your selling price. You will have a double advantage. You are getting at manufacturing cost, and you will sell your output to your customers at your regular and normal selling price, which will be, double bonanza for you. Otherwise, you will have, very huge profit. It will show as if receiving department performs super duper and transferring department is not performing at all. So the two department managers will sit with higher and lower price. Always transferor wants higher price, receiver wants lower price. Sit, negotiate and fix a price. That is called as which one? Negotiated transfer price. But of course, to fix a negotiated transfer price, the communication gap should not be there. That should be a licensing person. Maybe a CEO should be coordinating this meeting of transferring department people and what? Receiving department people, so that the communication clash is not arising, ego is not coming, okay, quarrel is not coming, too much quarrels are not coming, amicable transfer price is being fixed. So the negotiated transfer price, just buyer and seller should not just sit, like transferring department and receiving department, they cannot directly meet and fix a transfer price. It should be coordinated by a third person who may be for example, a finance person or a cost in charge or a management accountant or a CEO designated for this purpose. So that is called as which price? Negotiated transfer price. Negotiated transfer price. To avoid all these things, we can fix the transfer price based on return on investment. See, we evaluate the performance of the organization and departments based on return on investment. Simple. What is the operating profit that you are giving? What is the operating profit that you are giving? What is the investment made in that factory or division into 100? This is how return on investment is calculated. Like I said, I'm a cloth manufacturing section. What is the operating profit of the cloth making section? Divided by what is the investment made? Investment made in the sense, for this division, investment in fixed assets, current assets, how much is made? We work out which one? Return on investment. Based on that, we fix which one? Transfer price. That is called as, based on return on investment, we can fix a transfer price. Let us consider the same question. Okay, hope you copied this. Dual transfer pricing, negotiated transfer pricing, return on investment based transfer pricing. We'll move on. If division A has fixed assets $5 lakhs and current assets $2 lakhs, and return on investment desired is, let us assume 8%. Return on investment desired is 8%. Now we can work out the transfer price. How to work out the transfer price? Raw material cost or variable cost. What is the variable cost? We worked out $14, right? $14 into 10,000, 1,40,000. Fixed cost. Fixed cost I should recover $1 lakh. Then return on investment I want. 5 lakh plus 2 lakhs. Totally 7 lakhs is the amount invested in my division. Under the management and an average 8% is expected, means this is the return on investment expected. So this is a total divided by output. This is the total revenue that is expected from my department divided by what? Output. What is the output? 10,000 units. What is a mistake? $29.6 will be the transfer price. 29.6 will be the transfer price. Let me make a small alteration. It is actually $2 lakh and $2 lakh switch club, $1 lakh switch club. And return on investment, let us assume 5%. So 3 lakhs into 5%. 3 lakhs into 5%, 15,000. So this will be the transfer price. 25.5 will be the transfer price. Here we are fixing the transfer price based on the targeted return. I'll make alteration. This is 1 lakh vachikalam. Nama question dana change panikalam. So this will be the transfer price. This is nothing but market price. In this question, it is equal to market price. It may be less than the market price. It cannot be more than the market price. I altered the question because if the market price itself is 25 per unit, you cannot fix a transfer price of more than 25. Clear? Receiving department, instead of buying from me, they can buy it from outside. Earlier I worked out as 25.5. Will you accept 25.5? No. The transfer price will be cannot exceed the normal market price. Instead of buying from me, the same product or raw material you buy from the market, okay, you will get it to 25. So market price here can be the transfer price. It can be lesser than the market price also. It can be lesser than the market price, but transfer price cannot be more than the market price and it cannot be less than the, variable cost. So transfer price in all the situations will be, in IMA questions also, variable cost plus and cannot exceed what? Normal market price. This is another approach to transfer pricing. So these are the 7 approaches to transfer pricing. In IMA questions, they ask you essay type questions also. They will give a scenario like this. Okay, they will ask you to calculate different price using they will ask you what are the approaches. Maybe in essay question they can ask you what are the approaches they can follow in transfer pricing. They can give a base situation like this and they will ask you to work out. It can be based on market approach. It can be based on full cost, variable cost, opportunity cost, dual transfer pricing, negotiated transfer pricing, and which one? Return on investment based. Or where you have to type the answers, and give it kind of a thing. And it can be tested in multiple choice questions also. Using the return on investment, calculate the transfer price. Using the opportunity cost based transfer price, if division B needs so much, if division B needs so much, 4,500 units, what is the transfer price, like that they may ask you. So that, MCQ questions can be correct. And let us see the material also. That is what? Market based price can be there. Cost of production plus what? Opportunity cost transfer pricing can be there. Variable cost, full cost, it can be cost plus. This return on investment method is otherwise called as cost plus transfer pricing. This return on investment method is also known as which one? Cost plus transfer pricing. This is cost, this is plus. The profit that is expected or to be earned, decided to be earned, that is called as what? Cost plus transfer pricing we had seen. Negotiated pricing we had seen. Negotiated price, the price between the seller and receiver and the money. Arbitrary pricing is not a concept at all. It is not a concept at all. It is only a bookish concept. Just like that, okay, take $14, $20 like that, without any basic, workings, just arbitrarily you fix a transfer price. Guesswork, $20 per unit like that. That will practically will not happen. Dual rate pricing also we had seen. Clear? So within the ideal capacity means variable cost. More than that means variable cost plus opportunity cost, like that we had seen. So these are the different approaches to transfer pricing. Everything has its own advantages and disadvantages. You can go through the material. Okay, like a story form you can read, you will definitely understand. Okay, you can understand. The points which I explained to you, it will be there. Okay, which transfer pricing method should be used can be tested in IMA. It's a theory question in IMA. Which transfer pricing method should be used? Ensure that transferring department performance is not understated or overstated. Same thing, ensure that receiving department performance is not understated or what? Overstated. So from the transferring department end, because of the transfer, my return on investment should not come down. And because of the receiving of transfer, receiving department's performance should not be overstated or what? Understated. That is number 2. Number 3, in the interest of the organization, transfer shall be made. Just because division A loses and division B gains, should not stop transferring and pay a heavy price to external market and buy it. Heavy price to what? External market and what? Buy it. Transfer should happen within the organization in an amicable manner. Goal of the organization, vision and mission of the organization should not get affected because of this. The transfer pricing should not lead to any miscommunication or misconception or mismanagement amongst which one? The people. That is another one. In fixing the transfer pricing. And the tax consideration also you should look into if you are transferring between what? Two departments, like a company A to company B. When you are transferring, ensure that the taxation aspects also, you are not landing up in paying what? Higher taxes. At the same time, you are not violating which one? Federal tax laws. And at the same time, ensure that arm and length is settled. So tax consideration also should be looked into. Looked into. But in the overall interest of the organization, transfer should happen internally. Because look at this. Market prices, we make the cost is 24. If you buy from the market, you have to pay $25, which means you will be losing 1 rupee. So don't lose to somebody. Don't lose to what? Somebody. Instead, within the organization itself, it can be transferred for what? 25. Because profit of one organization or one division becomes cost of another division. Or cost of one division becomes what? Profit for the other division. So that should not be divisional. Overall goal, if you look at the overall organization's profit should get maximized. Okay, don't just look at the short run, goal of individual departments' profit or loss got affected, so I will not transfer like that. So you can go through that. Legal, regulatory, and limitations you have to consider. Whatever I explained, it will be there as objectives of transfer pricing. What are the points you should consider while fixing which one? Transfer pricing. Clear? So variable cost plus opportunity cost should be less than the market price. Or transfer price should be more than the variable cost plus opportunity cost, but less than the market price. You cannot transfer the goods at less than the cost and cannot be more than which one? Market price. So this is transfer pricing and its approaches. Transfer pricing and its which one? Approaches. If there is any doubt, please unmute and ask me. Do you understand transfer pricing? From this, sure shot MCQ possible and sure shot essay type question is also possible. As part of a lengthy problem, they will give you one situation. They will suggest you different methods of transfer pricing. Okay, you can just explain, like based on market price 25, based on full cost this much, based on variable cost this much, based on opportunity cost this much. Okay, we cannot express 5 and 6, not possible. Based on return on investment, if data is available, you can work out the transfer price based on what? Return on investment. You can give the different transfer pricing. You can suggest the transfer pricing shall be more than the variable cost, but less than what? The external market price. Like that, you can suggest in the exam.